How trend line works in trading. Before knowing what the trend line is, you need to know about the shift in demand and supply. This is as follows. The law of demand. The law of demand suggests that when there is an increase in demand for stocks at a lower price, the demand curve shifts to the right. As the demand increases, the number of buyers will increase. When the demand curve shifts, it determines that the price will increase in the future. The law of supply. The law of supply determines that when the price of the stock is above equilibrium points, it increases the supply, and the number of sellers will increase. As the supply increases, it determines that price will decrease in the future. So, more people sell the stock. When this happens, it creates a trend. What is trend? The trend is the direction of the price of a market, stock, or assets. There are mainly three types of trends in the market. Upward trend. An upward trend refers to the price movements of a market in an upward direction. The upward trend line is connected with higher highs and higher lows. The trend line is continuously going in an upward trend called as higher highs. And the trend line is lower than the previous peaks are called higher lows. Investors want to buy shares because the supply of shares is less at this time. It is a bull market, so the price will increase accordingly. The higher highs trend line is also known as the resistance line. And higher lows trend line is also known as the support line. Downtrend. A downtrend refers to the price moves lower in the market. The downtrend is connected with lower highs and lower lows. When the previous price is higher than the current price is known as lower highs, and the current trend line is lower than the previous lowest price, which is known as lower lows. The intraday trader wants to sell their stocks or set a stop loss to protect them from the continuous downtrend. And when the price goes down, long-term investors want to buy. It is a bear market. The price will decrease in the long term. The downtrend happens when supply exceeds demand. The number of sellers are more than the number of buyers who want to buy. Sideways. Sideways trend refers to straight or parallel price movement when the supply and demand of the stock are nearly equal. The prices will change according to the small range. There is no fluctuation in price. In this trend, the price is between support level and resistance level. When the price is at a support level, buy it. And sell it at the resistance level. It is an equally balanced trend. So, there is a flat volume of the stocks. In a sideways trend, it is difficult to trade and make money. Why to use trend lines? Understanding the direction of the market is the most important thing. Traders use the trend lines to evaluate the buying and selling points. We can evaluate the exact data point of entry and target of the stock. It helps to identify the exact amount of stop loss. It also helps to identify whether a trader has held a stock for a long position or sells at a stop loss price. When the price rises, the trend line will rise. And the falls, trend lines will fall accordingly. Support, resistance and trend line. Trend lines help to predict the areas of support and resistance. It helps to identify the charts at which the price chart is moving. In an upward trend, there is a higher probability of support holding, resistance breaking, and the probability of broken resistance reverse into a support level. In a downtrend, there is a high probability of resistance holding, support breaking, and probability of support changing into resistance. In sideways, there is no probability of support and resistance.